All right, guys, let's quickly take a look at the NFP data coming up a little bit later today. Now, look, this current geopolitical situation, it does complicate the way that we would normally trade something like this. That is true. But I also think in some ways it also simplifies the way we can trade it, because it drastically lowers the potential for attractive trades to take. For example, let's take a look at equities, right? It's so challenging right now. Equities is in such a massive amount of chop. I mean, just look at the NASDAQ here for a second. What an absolute mess this has been. And if you think about it, we haven't really gone anywhere in this market since October. We've had big swings up and down. Think about all of the things on the macro side that has happened over the course of the last 4 months. And we haven't gone anywhere, right? We're still very much stuck pretty close to the middle of that range. So I think equities are going to be challenging to trade today when it comes to the NFP, because good data could be good, bad data could be good, bad data could be bad, good data could be bad. I think honestly it'll depend on where the geopolitics is pointing at that time. So for example, if we get super good jobs data, that could be bad for equities because it means there's less need for cuts, and we'll talk about that in a second. But it also means that earnings potential goes up, right? Medium-term growth expectations should be positive on the back of that. So there's both positives and negatives. If we get super bad data, that could be good because it means, okay, maybe we do need to price in a little bit more cuts, because we'll see in a second the markets have already priced out almost fully priced out the second cut that was priced in for this year. So if we get really bad data, we probably go back to pricing in 2 cuts. But even though that's positive for equities, at the same time, you also have the negativity spilling out from a earnings point of view, right? Because if we do see bad data, that doesn't give you a very attractive forward-looking outlook for things like earnings, for things like growth potential. So equities is going to be an absolute mess. I could see them go up and down on good and bad news. That does not give me conviction at all to trade something like equities. What about something like gold? You know, gold's normally a simple one when we trade economic data on the US side, because bad data, which again leads to expectations of easy policy, could potentially mean upside for gold. If we see really hot data, it's normally bad for gold. Right now, gold hasn't really been trading that way, right? Gold has been more correlated to equities right now because it's a very high vol regime. I mean, if you take a look at commodity volatility right now, it is, look at oil. We're trading at an 83 handle for OVX. It's just absolutely crazy, right? Gold vol is obviously much lower, but relatively speaking, it's still trading at high levels. So in this type of high vol regime where you have rates vol up, equity vol up, FX vol up, commodity vol up, it shouldn't be a surprise to anybody that gold is selling off alongside equity. So if you have that, positive correlation to equities, it's not really clear how gold's going to trade, because again, equities aren't really clear on which direction they will trade. And again, this is just my opinion, right? You might have a very strong conviction that no, equities will go up on bad news or will go down on good news. Whatever your conviction is, obviously don't let me change your mind about that. But personally for me, I've said it many times when it comes to these geopolitical situations, if there's an easy trade, I will take it. If there's no easy trade, then I'm not interested in risking money on a maybe trade. If it's a super simple, super clear trade, then I'll trade it. If not, I'm just going to ignore it. So for me, I think gold as well as equities, I just don't see a clear path for either of them if we get good and bad data. Again, normally, what would we normally expect? Normally, we would expect very bad data to see upside in gold. If we see really good data, you expect downside in gold. If you think gold trades that way today and ignores the geopolitical situation and ignores equities, then by all means, trade it that way. But personally, I don't think that is the easy trade. I don't think that is the simple trade. I think right now, looking at how FX is traded so far this week, I honestly think that FX is by far the simpler trade to be looking at for NFP. And there's really only one outcome that I would be interested to trade today, and that is if we get a really solid beat coming out of the US data. It's threefold really. the reasoning behind that. Firstly, the dollar right now isn't really going up because suddenly everybody realized that, hey, the economy is actually doing great. The only reason why the dollar is going up right now is because we have a lot of safe haven demand going back into the US dollar. When you have a high vol environment, gold isn't attractive as a potential area to hide. When you have a high inflation environment like we have right now, bonds isn't an attractive area to hide either, right? Because you expect bonds to go down and yields to go up when inflation expectations are increasing. So you don't have that attractiveness for gold, you don't have that attractiveness for bond, which means that the dollar has really been the only game in town in terms of a haven play for this geopolitical situation that we're in right now. So the dollar is already bid on the geopolitics side. So if the data comes in really bad, yes, we would expect the dollar to sell off in the short term. But how long will it take the markets to just buy the dip? Because again, the dollar isn't going up because everybody expects the economy to do good. The dollar is going up because of safe haven bids. That isn't going to change because of NFP. It might see some short-term reverberations in price and we might see price pushing lower. But I honestly think that there's a higher chance that the markets push the dollar lower and then we see it rally right back up towards the end of the session, right? If the data is bad. That's the first reason, safe haven bids. The second reason is take a look at what's happened to rate markets. Now, a lot of this, I think, is mechanical in nature, purely because of how yields have been moving. Remember, we've spoken about this in prior inflation scare environments over the past few years now. Is whenever you have these types of inflation-focused sell-offs in bonds, what tends to happen when yields rise is you get that because OIS pricing and everything you see here, every single interest rate expectation here is based on OIS pricing. OIS is very sensitive to changes in yields. So when the yields change, when they suddenly go up massively, you would expect that to have a mechanical impact in how the markets view rate expectations, right? So what's happened over the course of just a week, take a look at where we were a week ago. A week ago, the markets were still pricing in comfortably, pricing in 2 cuts for the Fed at 57 basis points. Take a look at where we are just a week later, 33, right? We are not even pricing in 1.5 hikes anymore, right? So the markets right now they've been mechanically, we've seen a mechanical upside in the rates curve, and that is another reason to like the dollar right now. Now, arguably, you could say the same thing for all of the curves that are going up. But in an environment where you have the US dollar already safe haven bid, where the market's expected 2 cuts, now only pricing in 1, that's another positive for the US dollar. So again, the simpler outcome would be to have something that further feeds into that current sentiment, that further feeds into that current price action, which would of course be a solid beat. That would probably see the markets only dropping from 33 to 25 by the end of the year, signaling that we are only comfortable to price in 1 more cut by the end of the year. So second one, central bank expectations. The third reason why I would prefer a beat over a miss is positioning data, right? The markets coming into this week were still short dollars in the aggregate. It's still a straight short position. It hasn't been a monster one, but it is the second largest one apart from the pound, right? So bearish crowded is what we got into this week. I think a lot of what we're seeing this week isn't just purely safe haven flows. I think that's obviously the majority of the bid. But because of the safe haven inflows, it's probably just seen a lot of players that's been short dollars, long euro, for example, trimming those positions because it makes sense to do so in this environment. It's not just about the safe haven bid. Remember, when you compare these two economies, you've got the US, which is a net energy exporter. On the opposite side, you've got places like Europe, which is a net energy importer. Right? They import a shit ton of energy, these guys. So when you have these types of supply concerns and energy concerns, it's only natural and normal for, you know, these currencies to come under pressure, things like the euro versus that of the dollar. So there's more than just one reason, but positioning, I think, is definitely, some of that has been trimmed in this week, and I think there's more to be had. So those are the 3 reasons why I honestly think I've already spoken to you about why I think the other markets will be tricky to trade. I'm not going to look at equities. I'm not going to look at commodities. I'm only going to be looking at FX. And there for me, the only attractive outcome that I would want to trade is a massive beat in NFP. So what type of numbers are we looking for? The cool thing about the current situation is that because we have that because the dollar is already bid from a squeeze point of view, a safe haven point of view, an energy point of view, the central bank repricing, because it's already bid, I don't think we need much. I don't think as normal, because normally when we have these types of trades, we would want to see something that's both above the market's maximum as well as above the prior. I don't think we need that today. I think anything north of 100K will already do the trick, because take a look at this. If you look at the forecast distribution, even though we've got a huge range here between -9 and 125, you can see that there's only three participants that is expecting something close to 100. Then you've got that outlier at 125, which means that this entire range of forecasts will all be surprised if we get a 100K print. So I don't think we need something above 130. I don't think we need something above 125. I think anything north of 100 and up, that'll be my trigger for a possible upside in the US dollar. What about the unemployment rate? I think there we can be a lot more. It's a lot simpler to look for. There I'll be happy with anything 4.2 or lower. I don't think we need something below the low, purely because if we do get 4.2, it's already going to be below the prior, meaning that if you look at the country data, it means that employment or unemployment will already be on a downward trend if we get 4.2, right? We were at 4.6, then we drifted down to 4.4, then we drifted down to 4.3. So at 4.2, even though it won't be below the minimum, it'll still be below the prior, which in my opinion should be good enough. So 100K on the jobs numbers, 100K on the jobs numbers, 4.2 on the unemployment rate. In terms of earnings, look, there I would be more comfortable above the max for both, because that is also in line with the prior, right? So if we have monthly earnings coming in 0.4 or higher, I'd be happy with that. If we have year over year coming in at 3.7 or higher, I would be happy with that. I don't think that is, even though we are in a more inflation driven environment right now, I don't think there's going to be as much focus on earnings as there probably should be. But anyway, we'll be looking for that as a green number, right? If we can get anything above forecast, I think that'll be good enough. So in terms of trading this, like I just explained, dollar obviously upside would be my play. We're currently testing huge levels of resistance here, major level of resistance for the dollar index, right? We're coming up against that 99.50. It's been a huge area of resistance for this going back all the way to June of last year. We've had these false break moments previously, right? That is something worth keeping in mind. But the sexy trade here would be super hot jobs data that sees us break above, potentially retest, and then we target something a little bit higher going into the new week. Now, having said that, I want to be long the dollar, but we're going into the weekend, right? The risk is that we long dollars, we're super happy, we get a nice trade. Even if you move to break even, what if we get a huge resolution over the weekend? IRGC and the US strikes a deal to stop all, war activities. Think about the size of the gap that we're going to get on Monday in the dollar. Do you really want to be long it when that happens? I don't. So, unless I can get in at a good price and have a hefty margin to work with in terms of my break even, I'm not going to look to hold this much longer. Right, I'll probably look to close it towards the end of the session. I just don't think it's going to be worth holding on to that risk, with the type of gap that we could see if there's a resolution. So you can either trade dollar index. I think that'll be a simple one, looking for a breakout of that 99.50. Alternatively, the one that everybody should have access to for those who don't have access to the dollar index would just be to trade the euro, right? Nothing wrong looking with something like the Aussie, but it has been the strongest currency on the session. The CAD's been strong. The euro has just been consistently weak throughout the week. And again, it's very much related to what we're seeing in energy, right? As oil prices keeps on pumping, you would expect that to be supportive for the dollar, negative for things like the euro. So euro, I think, is just the obvious answer there to aim for. Technically, I also like this thing. Momentum is very recently over the last two sessions, or the last session really turned bearish, which is obviously not good. We're trading below the 200-day moving average. We've broken through trend support. We had a classic breakout retest opportunity here, or structure here. Technically, I think it points lower. We just need jobs data to come in good. If it does come in good, look, 115.40 or 115.50 is the next area. That is the implied volatility lows, or 115.70 rather. I think we slice through that fairly easily. Next area to aim for would be this series of lows coming up around that 115 flat. We also have the second implied volatility low there. If we manage to break below that, the next key area to aim for, if we get lucky enough, would be a move back down all the way to 114 flat. So some big figures we can aim for: 115, then 114. Let's see what type of number we get. And again, remember, all bets are off for this if between now and NFP we get some miraculous breakthrough, right? So geopolitics, unfortunately, is in the driver's seat. And like I said at the start, it does mean complications for things like equities. It does complicate the way we trade gold, but I honestly think it really simplifies the way we would look to trade something like the US dollar. So it's not all bad. I think it's just given us a much simpler, cleaner way to express a big surprise, obviously, if it's a hot print. So that's just a quick look at the NFP data coming up. Any questions, as always, don't hesitate to let me know.